Have you ever wondered why interest rates change and who controls them? It's the Federal Reserve, or the Fed, that maintains a stable financial system in the US. By the way, the chairperson of the Federal Reserve is the second most powerful person in the United States after the president. Hi, I'm Lisa Sheng, your go-to mortgage person with Geneva Financial. Today, I'll explain how the Fed plays a role in controlling interest rates and why they even do that. The Federal Reserve wants to maximize employment, ensure stable prices, and moderate long-term rates so that they don't double or triple overnight. To do so, the Fed uses three tools. Today, I'll focus on one of them called discount rate. Let's start by presenting players. There's a Fed, banks, like your Citibanks or your JP Morgans, etc., and the people. The way the system works is that people deposit money in banks, and banks deposit a percentage of that money known as the reserve requirement at the Fed. Conversely, the Fed will lend money to banks, and banks will lend money to the people. The Fed charges banks on these loans is called the discount rate, which plays a major role in most every interest rate that you can think of, from the rate of a home mortgage to the rate of credit cards. When the economy gets tough, just like during pandemic 2 years ago, what happens is that people don't spend money, businesses fail, and be forced to close. More people lose their job, aka income, they will stop borrowing from banks, and money will stop circulating altogether, resulting in a recession. So what does the Fed do now? But before that, let's think about what we do when products don't sell at a higher price. We lower price, right? Just like that. The Fed lowers the discount rate to make it cheaper for everyone to borrow from banks, to homeowners, to car buyers. Lowering interest rates stimulates borrowing and, of course, stimulates spending. Great. All the problems solved. Not quite. Suddenly, we have too many people try to buy stuff, so supplies can't keep up with demand. Therefore, prices of goods go up, leading to inflation. As mentioned earlier, anytime the economy gets unstable, the Fed needs to step in. As the economy improves, the Fed wants to keep it from overheating. How do they do that? Number one, give out more stimulus checks. Number two, raise interest rates. That's right. The answer is number two. They increase the discount rate, just like we've been seeing for the last 18 months.